Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But the key macro drivers, the driver, of course, of the first bear market was when they came off the gold standard. Everybody realized the U.S. fiscal position was bad and it went down. The driver of the bull market was a real change in the fundamentals when Volcker came in and hiked interest rates to 20%, and the U.S. economy responded and started to grow. Huge bull market in the dollar. Then we had an event where basically the countries were getting together to trying to push down the value of the dollar or push up the value of the yen through the Plaza Accord. And there were some changes in the fundamentals too, and then we had a bear market. And then the next major bull market was driven by the U.S. stock market boom in the 90s. That brought in hot money and long-term investments into the U.S., money coming in based on the fundamentals of the U.S. companies, making the U.S. more attractive. And then we had the bear market that started around 2002, and whether or not we're still in a long-term bear market or not, which was led by a pop in the NASDAQ market and a massive amount of liquidity created by Greenspan and Company. We happen to think, and this is an outside view, that the credit crunch is the next major fundamental event that really could change the picture and launch the dollar into another major bull market. We won't go into that here, but we're still open to that. And the reality is the credit crunch really did define the low so far in the U.S. dollar. And at the moment, it looks like that low may be breached, and the idea that the credit crunch is the driver, may go by the wayside, but we'll see. But that's a major sea change event, and I'll touch on that real quickly. This is just a setup, again, just to tell you how we go about doing fundamental analysis. Fundamentals, the mind of the market. That stuff we think about. All that kind of stuff. And you got to keep in mind that we tend to think of fundamentals as, and this is kind of one caveat, as solid. We can always hang our hat on fundamentals, but fundamentals change very, very quickly too. They're ephemeral. We often see a feedback loop between prices and fundamentals, and that's something also you have to be careful about. Let me maybe explain that. Currencies are driven by the fundamentals, and fundamentals are driven by currencies. A rising currency can indicate, can bring confidence to a country, can lead to hot money coming in because the currency is rising. That can lead to more capital investment, which can self-reinforce. So they can have that feedback loop. So the currency started to move, more money came in, who led, who followed type of thing. So keep that in mind. And also, as we said, a fundamental 1 week all of a sudden can change the next week. So these things change too. So I think it's good that, when you think of the fundamentals, think of the intermediate to long term as we try and trade on, something, that is not going to change immediately. We never know if it is, but in general, we can see some of the trends in the fundamentals on the growth side and the interest rate expectation side. I tend to look at the top-down view, obviously. And ultimately, this stuff right here is about identifying capital flow. As I said, currencies are driven by supply and demand of capital. That's it. That's the best you can say. You can give all types of reasons and rationales, and I'll give you a few on the current trend, but the best you can say is this. And as I said, sometimes you can't identify the major capital flows by just the news or the fundamentals you can see. There's a lot going on underneath the surface you can't see in global economies. We tend to use the intermarket analysis to really help support our fundamental move, meaning we look at the different asset classes against the dollars and against the other currencies to see if our fundamental view makes some sense and help validate our fundamental view. Again, that's a whole different set of analysis is looking at intermarket, but we tend to use it, and it kind of bumps up against the fundamental area in terms of analysis, even though it's somewhat technical. As I said, we like to develop the most likely view and the probable view when we do our fundamental analysis. And we constantly like to keep those two views in our head. The consensus view, this is what people think. This is a plausible change to the fundamentals that really could change this trend. We're trading off of this one, and we're watching this one. We're constantly watching this, and we're constantly open to this one being wrong, but we're constantly open to this one being wrong. Stay flexible, always stay flexible, and by developing alternative views, it forces you to do that. In general, and this is just something from a trading perspective, and again, it's not something that always helps, but over time, over the long term, if you've been in this market a long time, it tends to keep you somewhat out of trouble. When you put on a trade, when you make a trade, when you have enough confidence to put on a trade based on your most likely view, the first question you should ask yourself after you put that trade on, and ask yourself constantly as the trade's on is, boy, aren't I right? The first question you should ask is, where am I wrong? Where am I wrong? So every day you're constantly, continuously, or every week, however much time you want to spend to this, and again, that's why the currency options long term can be great. You don't have to watch your screen every day. Every week or weekend you can do your reading and say, the reason I put this trade on, is it still right or is it wrong? Is it still right or is it wrong? Basically, you're asking yourself, is it wrong? Is it wrong? Is it wrong? So you can be open to information coming in to invalidate your view. The problem is people put trades on, and then they look for information to validate what they saw. They cast away the negative information. They pick those pieces of market information that says they are right. You got to turn that around and look for that fundamental market information that says you are wrong, and that keeps you on edge. George Soros said that every good trader is a little bit paranoid, and this is why, because this is exactly what Soros does as a trader. When Soros puts trades on, he's constantly asking himself, where am I wrong? This is a bad trade. What did I do wrong? Why did I make this trade? He's just constantly questioning himself, and that's why he's been so successful over the years. And he has the ability to build probable scenarios that make sense and move much more quickly. That's why he was able to make so much money on that famous trade where he basically broke the Bank of England. He built a plausible, probable alternative scenario that other people didn't see. He knew that Britain couldn't stay in the monetary system where Maggie Thatcher had pegged the currency once John Major came in office. It was just politically unviable, he thought, and they would have to come out of the system. He identified that. He and Druckenmiller, his partner, identified that before others did. And again, if you're trading pure technically, you never would have thought about that. And there's a situation where that alternative scenario paid off, and he made the famous couple billion in one day. Wouldn't we all like to do that, obviously? But again, you don't need to make a couple billion in one day. But if you can make some money here and there and control your risk better long term, that's what it's all about, doubles and singles. He happened to hit a major home run with that one. This allows you to build scenarios, as I said, based on these alternative views. We create market themes. We bring them down to dollar scenarios because the dollar is the most important. It's the center of the universe in currency trading. The major pairs trade against the dollar. They don't trade against the euro or the pound. They trade against the dollar because it's the U.S. economy is $14 trillion. It's the big dog in the world. The four major economies combined can reach the U.S. Now, if we count the Eurozone as one economy, it's larger than the U.S., but the Eurozone is not one economy. It's a bunch of countries that make up the Eurozone. Germany is the number one and the driver. The dollar is held in about 66% proportion on all global central banks, denominated in dollars. The dollar decision is the first and most important decision, and then you move from there. And again, we develop scenarios for the dollar, and I'll show you what our scenarios are at the moment.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.